jumping straight into Marvell Technology today. Everyone is watching the price action, but the real story is the massive acceleration in data center revenue and custom AI silicon.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get rolling, do us a quick favor, hit that subscribe button and smash the like. It helps us keep simplifying these complex market moves for you every single week.
All right, let's get into it.
Okay, so we're looking at a company that just posted Q3 fiscal year 2026 net revenue of $2.075 billion. Now, that is up 37% year over year.
37%.
I do.
I want to pause on that number for a second. In the world of hardware infrastructure, that's a massive jump.
It's huge.
Usually, when we see companies of this size, established players, you're looking for single-digit growth. Maybe, if they're having a great year, low double digits. But 37%,
Right.
that suggests something fundamentally shifted. It's not business as usual. So the question is this sustainable, or is this just a one-time blip?
That is the multi-billion-dollar question, right? And the answer seems to lie in exactly where that money is coming from.
Okay.
If you look at the breakdown, it's not general growth. It's highly specific. Their data center revenue is forecasted to grow about 25% in fiscal 2026.
Which is already impressive.
Already impressive, but then it's projected to accelerate even further to 40% in fiscal 2027. So we're not seeing a slowdown, we're seeing them hit the gas.
Okay, let's unpack that, because data center revenue is kind of a catch-all term, isn't it? It gets thrown around a lot.
It does.
It could mean storage, legacy servers, just more internet traffic. So what specifically is driving that acceleration to 40%? It's not just people saving more cat photos.
No, you're right. It's not the boring stuff. It is specifically custom AI revenue. This is the secret sauce.
Okay.
This segment alone is hitting $1.8 billion in 2026. That's a 20% increase. But here's the kicker. It's projected to double to $3.6 billion in 2027.
Doubling in a single year.
In a single year, from 1.8 to 3.6 billion.
That's the kind of metric that makes you sit up and pay attention. But let's clarify what custom AI actually means here. We're not talking about selling commodity chips off the shelf.
Right.
Right?
Not at all. Spot on. Think of it like a tailored suit versus something off the rack.
Okay.
The big cloud providers, your Amazons, your Googles, they have these massive specific needs for their AI models. They don't want a generic chip. They want silicon designed exactly for their workloads. Marvell is the tailor.
That's a great analogy. And because they're the tailor, they're selling IP, not just a product.
Exactly. And because they're scaling these high-end products, they're getting more efficient. The gross margins just hit 59.7% non-GAAP.
So as they get bigger, they get more profitable per unit. They aren't sacrificing margins for growth, which is a common trap.
Right.
Rising margins suggest they have pricing power, which leads to the obvious question. Why can't the competition just copy them? If this is such a goldmine, why aren't other chip giants eating their lunch?
It comes down to the moat. And for them, the moat is deep, complex engineering. Marvell has a serious technical edge in custom ASICs and optical DSPs, specifically this Era 3-meter DSP.
Okay, we're getting into the alphabet soup here. Let's translate that.
Yeah.
ASIC is a chip for one specific job. DSP is a digital signal processor. But why do the 3-meter and the speed specs matter to an investor?
Okay, here's the simplest way to see it. Think of an AI data center as a giant brain. The GPUs are the neurons doing the thinking.
Right, the NVIDIAs of the world.
Exactly. But those neurons are useless if they can't talk to each other instantly. Marvell provides the nervous system. That Era chip lets data move at blinding speeds between all those processors.
So if the nervous system is slow, it doesn't matter how smart the brain is, you create a bottleneck.
You create a bottleneck and you waste a ton of money. And the 3ME part matters because it's smaller, more power efficient, it generates less heat, and heat is the absolute enemy in a data center.
Got it. And this isn't just theoretical, right?
No, they are the supplier for AWS's Trainium 3 and Trainium 4 chips.
Now that is a huge validation. AWS is the biggest cloud provider on the planet. If they're designing Marvell into their custom AI chips, well, that creates incredibly high switching costs.
High switching costs are an investor's best friend.
Let's explain why. Why is it so hard for Amazon to just switch?
Because once a company like AWS designs you into their core architecture, they can't just rip you out next year if a competitor is 5 cents cheaper.
It's not like changing a light bulb.
Exactly. It would mean redesigning their entire software and hardware stack. That relationship is sticky. It's like a marriage, not a first date.
Hmm.
And it's not just the custom chips. Their switching silicon revenue, the gear that routes all this traffic, is projected to hit $500 million in fiscal 2026.
So they lock in the customer on the compute side, and then they connect it all on the networking side. It's a pincer move.
Right. And despite all this, the market is still treating them like a second-class citizen. Marvell is trading at a 25% valuation discount to its peers.
That's the value angle. The market is Christ in perfection for some of the other AI names, but Marvell seems to be lagging in the hype cycle. Maybe the market thinks that doubling narrative is too good to be true.
Maybe, but the company clearly doesn't think so. They've authorized a $5.0 billion share buyback program.
$5 billion. That is a massive signal of confidence.
It's enormous. Companies don't do that unless they believe their stock is significantly undervalued.
Right. They're putting their money where their mouth is.
So just to recap the bull case, accelerating revenue, deep competitive moat with AWS, and the stock's at a discount while management is buying it back.
It sounds like a slam dunk on paper. If you only looked at that, you'd be all in.
It does look incredible.
But there's always a but. We have to look at the flip side. Let's dig into the risks, because there's one number that makes me a little nervous.
I know exactly where you're going, the concentration.
Yeah.
We have to be real about this. The top 10 customers, they represent 81% of Marvell's revenue.
81%. That is extreme. You don't have customers at that point, you have bosses.
You really do. Their fate is tied to a very small room of people.
So let's spell out why that's dangerous. If just one of those hyperscalers, Amazon, Google, decides to change architecture or delay a rollout, Marvell's stock doesn't just dip, it crashes.
That's the nightmare scenario. Sure, switching costs are high, but a company like Amazon has infinite money. If they decide they want to cut Marvell out, they can afford the pain to do it.
Right. If Amazon sneezes, Marvell catches pneumonia. We've seen it before. You're either designed in or you're at zero.
And it's not just the customers, it's the macro environment, geopolitics. There's still significant China exposure in the supply chain.
The chip war is real. Trade tariffs, regulatory changes. That adds a layer of unpredictability that has nothing to do with how good their tech is.
And they aren't alone. They're fighting against absolute giants. You've got Broadcom and Cisco in the switching market.
Broadcom is a beast. They are aggressive. They have massive scale.
Yeah.
They're not just going to roll over and let Marvell win.
Absolutely not.
There's also execution risk, right? That whole doubling of AI revenue depends on them integrating new tech successfully. They acquired a company called Celestial AI for photonic tech.
Let's touch on that. Photonics is basically using light to move data instead of electricity.
Exactly. It's the holy grail of speed. But it is incredibly difficult to manufacture at scale.
And that's the risk.
Right. Integrating an acquisition like that is hard. If that photonic tech takes longer to mature than the market expects, that growth thesis starts to slide. It relies on them executing perfectly.
So we have a clear divide. The bull case is pure growth and value. The bear case is extreme concentration and execution risk. What are we watching for in the next few weeks to break the tie?
Okay, the immediate triggers. First up, earnings. Q4 fiscal 2026, expected in late March. The key metric to watch is if they hit that $1.8 billion target for AI revenue.
If they miss that even by a little.
The whole acceleration story takes a hit. It creates doubt.
Exactly. Then look for product catalysts. Keep an eye out for news on UA-Link or their new ESUN switches. We're talking 100T switches.
And UA-Link, the Ultra Accelerator Link, that's an industry standard. If Marvell announces they're shipping silicon for that, it proves they're winning the connectivity war. They're setting the rules of the road.
And on the macro side, watch for updates on that Trainium 4 ramp with AWS. If Amazon says they're deploying it faster than expected, that's money directly in Marvell's pocket. It confirms the sticky moat.
And finally, follow the money. We've seen big players like Triasima and Nord1 accumulating shares.
Why does that matter to the listener?
Because those institutional funds, they have teams of analysts doing deep diligence. When you see funds like that stepping in, it usually means they've done the homework on the risks we just mentioned, and they've decided the reward is worth it. It's a signal the smart money is positioning for a breakout.
So let's wrap this up. What does this all mean for you?
It's a classic risk-reward setup. You aren't buying a safe, slow-moving stock here. You are buying a highly concentrated bet on the future of AI infrastructure.
Here's the final verdict. You have a company growing revenue at 37%, trading at a discount, with a massive $5 billion buyback. The risk is real, that customer concentration is scary, but the reward is being the backbone of the entire AI build-out.
It's the picks and shovels play, but for the 21st century. In the AI gold rush, Marvell is selling the high-tech shovels.
Exactly. While everyone is fighting over the GPUs, the hardware that gets all the glory, the easy money might just be in the connectivity that links it all together. If the brain can't talk to itself, the AI doesn't work.
And Marvell makes it talk. It's a position worth watching.
That's the lowdown on Marvell Technology. Thanks for joining the Easy Money Show. We'll catch you on the next one.